What does it look like when two leaders, each defined by experience, innovation, and performance, unite to elevate Canadian real estate lending? With nearly a decade of serving the needs of investors, borrowers, and mortgage brokers in the alternative market, Neighbourhood Holdings has now taken a major step forward by acquiring Verge Asset Management, forming one of the largest alternative mortgage lenders in Canada. Together, they manage nearly $800 million in mortgages across more than 2,000 borrowers and over 3,000 investors nationwide. Through the Neighbourhood banner, the team works directly with mortgage brokers across Canada, providing short-term mortgages for quality borrowers who may not fit traditional bank criteria. Every loan is backed by real assets, ensuring a measured, conservative approach, seeking to provide investors with stable income while preserving invested capital. Whether you're a mortgage broker seeking flexible financing options or an advisor looking for regular income solutions, Neighbourhood's expanded reach brings track record, transparency, and opportunity, now even stronger with Verge's 30-year legacy. To learn more about the Neighbourhood, visit neighborhood.com to view the offering memorandum or speak to your financial advisor today. This is not advice, and consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 217. As always, joined by the three amigos. We've got the Boomer over in Halifax. Welcome back to the show. Richard Diaz in Montreal. Richard.
Hello. Yes, my hockey career has come to a grinding halt. I took a slap shot in last week's game and I sprained my wrist. That's the update.
I've never heard of anyone doing that before. It's usually not a good sign.
No, it's not. I'm fragile. But so I'm going to take off this week and we'll be back out there next week.
Were you able to
the backup
raise
goalie?
Sorry?
Rich, did you raise the puck,
goalie,
though, when you hit it? Were you able to get it in the air?
An inch or so off the ground.
Oh, man, this is painful. You could be like Goldberg. We should just strap you to the net.
Yeah. So there you go. That's it. I'm injured in my old man league. But that's not the exciting news. The exciting news is that we did the amazing event in Toronto, right, Keith?
Yeah, we had the first Loonie Hour Investor Series with Ben Rabideau. That was a good night, Rich. That was a lot of fun. Steve, everybody I spoke with said, "Where's Steve? We're so looking forward to seeing you." But you'll be at the next one, of course.
I got the FaceTime with you guys after your third bottle of red wine at dinner there. That was
a fun night too. Hey, a special hello to Lou from Chester. He asked me to say that because he wanted to impress his partner with that. But everyone, we had it was over 200 people attended the event. Ben is an amazing deep dive into the Canadian housing market, really showing everyone where the strength is and where the weakness is and what could potentially stabilize. He was somewhat calling a bottom, I think. Wasn't he, Rich?
I mean, he's cautiously optimistic, I think.
That except for the rental market, that still looks pretty weak. And then,
right.
Rich, why don't you just share what you went through with everyone?
I talked about
not your 40-minute version.
Okay, all right. Well,
did you ramble?
No, I didn't ramble. We're gonna have to figure out the timing because I have lots of stuff to talk about, and Keith won't let me. But no, I'm just kidding. I mean, I talked about global risk being synchronized and really how things that are going on outside of Canada can, and in my view, will affect the Canadian equity market and bond market, and how we can't sort of ignore what's going on in places like France and the UK and Japan and China and Germany, etc. I also thought was the other thing the other point I tried to make, which I'm not sure if I did as well as I'd like to, but in the future I will, is how each of those countries sort of shares something that's going on in France and Germany and UK relates to what's going on in Canada, whether it's interest expense or lack of productivity or climate policy run amok, etc. And so basically you got to pay attention to what's going on outside of Canada, even though Canada's the greatest country in the world, and Toronto's the most important city. But
it does go around Toronto, yeah.
Yeah, that's right.
I share with everyone how we manage portfolios for clients considering all of these risks. But I specifically focused on the bond market, as well as what's happening with really the foundation of the monetary base and the bank reserves and how the Fed has to use that with their consideration what they're doing. And the common theme with it is that there's not a lot of liquidity right now in the U.S. banking system because the reserves are quite low. They've been drawn down. So it's highly, highly likely the Fed is going to engage again in QE. It could start as soon as next week, but they have to do this. They have to, if they don't provide liquidity to the system, we're probably going to see another experience that we had in December of 2018, Steve. Remember in repo rates, they went from 2 to 10% overnight. So we're literally hours away from something like that. So I suspect the Fed are going to be proactive with it. And then just touch a little bit on equity markets, as well as crude oil markets as well, that we see it as a really good launch pad into next year. Everyone, this event is not recorded. It's only for those who attend. We call it a private event, private conversation. But we had a lot of fun, Rich, and Steve is lining up our schedule for next year as well. So we're right around the corner with it. So thank you to everyone for coming. It was a lot of fun.
Yeah, a lot more road trips planned for 2026. So we'll be announcing that probably early in the new year. But yeah, lots going on. We'll get into the central banks and the potential path for QE here moving forward. But this week we had a special interview with Heather Exner-Pirot. She's been on the podcast. This is actually her third appearance. It really knows all things Canadian natural resources, energy. She's one of my favorite guests. Obviously, that's why we've had her on now for 3 times. Keith wasn't able to join us on this interview. We pre-recorded a day earlier than we are today. But Rich, you and I had a great conversation. So without further ado, let's jump over to our conversation with Heather Exner-Pirot to discuss everything between the Carney and Alberta MOU, the Nutrien potash deal, and everything that's happening in the Canadian energy space, because there is a lot of news to keep up with. So without further ado, let's jump into that right now. Heather, welcome back to the Loonie Hour, the third time, three-peat.
I know, third time's a charm.
You're one of the few that we've had back, so that's always words of encouragement. Obviously, we have super appreciate your time. I mean, we've been following your Twitter feed's been, I think, super timely, just given all the commotion that's happening in the energy space, natural resource space across Canada right now. I guess, like, first and foremost, to kind of like start things off, what's your discussions been like after this MOU between the federal government and Alberta? Obviously, it was like highly anticipated. Us at the Loonie Hour were skeptical early days that it was ever going to happen, but we have this MOU now. Are people in your world, are they optimistic? Are they skeptical? Are they kind of like, well, it's probably just a bunch of words on paper and it doesn't mean a whole lot? Like, what's the general vibe right now in your space?
Yeah, I'll say on the policy side, very excited. Like, this is a bigger win than I think Alberta ever thought it was going to get with a federal Liberal Prime Minister. And if Danielle Smith is happy, I think, most, policy conservatives in Alberta on the policy side are happy. On the industry side, some of this is just, I said, like, we've been punched in the face for 10 years and it feels so good to stop being punched in the face. And we all saw that Prime Minister Carney got that 2 standing ovations at the Chamber of Commerce after he did it. That is an acknowledgement and respect that Carney did expend some political capital for it. Guilbeault resigned immediately. There's some of the base that doesn't like it. But Carney went out on a lib in favor of the sector. So people are very appreciative. Some of it is still in the details, so there's a lot of skepticism, a lot of fatalism in Alberta about Ottawa's intentions. So there's going to be that hardcore that just doesn't believe anything good can ever come out of Ottawa, that doesn't believe a pipeline will ever be built. But there's some things in there like clean electricity regs carve out. Like for electricity, this is already go time. Emissions cap being gone, that's already going to attract some investment. So we'll see what it all plays out in the long term. But there's some immediate wins also, I would say.
Can you walk us through kind of the sort of finer details? Like, so again, the cap on oil and gas production has effectively been removed. You've got your net zero power rules have been withdrawn. There's some concerns, I guess. Maybe you can kind of unpack it for us a little bit more, but like the carbon tax, industrial carbon tax rising to, I think it's 130 per ton. You have the mandatory methane cuts plus the Pathways Alliance project. What, like, can you kind of walk us through, like, I guess, like, are these real impediments?
Yeah.
Are there some nuances here that we're missing?
Let's start with the good news, which is, I'm an optimistic person. The good news is the clean electricity regs, like I just mentioned. If I'm sure your audience is very familiar with AI and the data center build out and the money that's been going into data centers. And Canada has not been competing for that, probably the largest capital outlay of the past decade. And because of the clean electricity regs, our hands were tied behind our back. The United States.
Just high level clean electricity regs for people that.
Yeah,
we're here in BC.
Yeah, net zero by
hydro.
2035. And so it means basically no new natural gas generation after January 1st, 2026.
That's so crazy. That is so crazy.
And Electricity Canada, every producer, Saskatchewan has already said we're not doing it, so it was just like, this is impossible. We will freeze in the dark. But even Atlantic Canada, are needing to build new natural gas generation. Anyways, all we should say is, Alberta has a deregulated electricity market. We have the cheapest natural gas, abundant, we'll never run out of natural gas. And we couldn't build natural gas generation to take advantage of that center. Like, we're literally missing out on tens of billions of dollars, if you ask me. We should be a very attractive jurisdiction because you're also using less electricity for cooling because we're a much cooler jurisdiction than Texas. So to have that gone, the electricity guys are like, it's go time. Like, tomorrow is go time. I think you're going to see investments in Q1 2026 based on that. So very positive in the near term. Emissions cap, I know we're all like hyper focused on this pipeline. That pipeline for me is a 2030, 2031. But we've already heard in the last month, both Enbridge saying we're going to expand our pipeline egress by 400,000 barrels. That's a lot. And Trans Mountain saying 360,000 barrels. So we basically got a pipeline being built, the equivalent of a pipeline being built with these expansions. I don't think they would have announced it, and we wouldn't have been able to fill it if the emissions cap wasn't, finally for good dropped. And so again, that is go time. For 5 years, the sector can grow production. On the other things, so the grand bargain, the messaging, it's not clear at all what's happening because the messaging has been very different depending on who's talking about it. I know some people don't want a carbon price at all. Alberta was the first jurisdiction in North America to introduce an industrial carbon price. It has survived progressive conservative, NDP, UCP governments. There is a market built around it. There are some business plans that are built around having it. What this does, in my mind, is positive, is it says it's going to go from the government's hands to Alberta's hands. And Alberta is obviously very conscious of where's the line and where's the limit for competitiveness. And if you do have to pay 130, let's say, if that accrues to Alberta can distribute those revenues in different ways. You know what I mean? So I have no idea what they're going to do, but either they could just pay for Pathways itself, or they could provide other tax incentives or lower taxes or things like that. And the other icing on the cake was that enhanced oil recovery for the first time was introduced. So that is sequestering carbon, but usually in a well, you might get 15 or 20% of your hydrocarbons out. But if you can stick the carbon dioxide back in, that's more pressure and it's pushing more of the oil and the gas out. They already do this. We already do this in Canada, but with no benefit. You don't get paid for that carbon sequestration. They do in the United States. It creates a business case for sequestering carbon. And it also gets more of your oil out of the ground and doesn't ruin your well. So if you're the royalty holder, Alberta, you're happy to get as much of that oil out of the ground and not have it stranded after that well is closed. So those are the positive things. I just want to say, I'll just finish with this. Alberta knows oil and they're not stupid and they want to maximize the royalty. Pathways Alliance is oil sands companies that are publicly traded. They are accountable only to their board and to their shareholder. I don't think they're going to agree to a deal that is going to see their stock price plummet. And so however it emerges in the end, I just can't see that it will be something that is bad for the oil and gas sector because the parties negotiating it don't want that.
Okay, but best laid plans of mice and men. Where do you think, they are in effect? Danielle Smith I know she's happy. You seem pretty happy. The oil companies seem happy, but they are making a Faustian bargain, right? They're making it a pact effectively with a man who wrote a book 5 years ago about how he wanted to destroy the oil industry and was the CEO of GFANZ, which is the Net Zero Banking Alliance. So sorry, can you assuage my skepticism about his sincerity about improving Canada's oil egress?
Well, I'll tell you what, we say a lot of things about Carney. He seems to be better at math than the rest of his caucus. And that's an understanding how this economy works. And so doing this deal and also understanding public polls, which is that the vast majority of Canadians do want more pipelines. And it was a winning hand to say that you're going to build pipelines. So again, right now, even which is the status quo, things are looking good for oil and gas. And Rich, you put out the great chart showing that decoupling of the WTI price and the Canadian oil and gas stock index. And I just think, for me, if I'm looking at this in a 30,000-foot view, I'm not an investor. I don't make money. I just, I'm curious where the policy is going to go and where the politics of it are going to go. We are chomping at the bit at $60 WTI to create more egress. Enbridge and Trans Mountain are announcing new ways to get more Canadian oil and gas out. Shale is still not peaked. Oil is still cheap. And what will happen in 3 years when shale has peaked and oil is $80? The pressure for this pipeline is just going to increase, and the pressure to want to maximize the returns for Canadians is just going to increase. And that is why I'm optimistic. I just think this is the perfect time in the commodity cycle for all this to happen. And I'll say that's what happened. It was the commodity cycle that pushed the politics of this to work out so favorably for these sorts of things. And same on the AI front. There's just too much money being left on the table and too much, trust being put into the United States to have to keep our data, to not, it was just too illogical. Anyway, so at least I'll trust in the wisdom of the Canadian voter, which does not want to be poor and weak.
Well, I'm not so sure that we don't want to be poor and weak, but no, I'm just teasing. But just to update that Canadian equity market sector, oil and gas, which is about 17% of the total equity market for Canada, continues to tick higher, even as oil price of WTO hits $58.8 per barrel. Steve.
No, I was just kind of curious on just to circle back on the carbon capture request under the MOU. Is that typically a project that these companies would do if there was no requirement to do it? I know the technology is there's some benefits to the technology, but to me it sounds like it's also going to be very expensive. Is there actually, I guess, how excited or eager are these companies to actually push a project of this nature through?
It's wildly expensive, the pipeline capture. If that's the way you go, we're talking about $20 billion. And that's a huge chunk of change. And no investor is going to come forward with that kind of money and see no return back on it. So it does get tied into, I think, the promise of higher prices, the anticipation of higher prices, and the anticipation of more egress. That if we're going to be producing 1.8 million barrels more than we are today, that there's a little bit of slack to work on the environment. But I'll just point out, Pathways and these groups have been working on emissions reduction constantly, since 2012. So it's not as though this is the first time that they're thinking about it or putting money into it. They've put, billions of dollars into it. They've been quite successful. They must think that there's a case for it. Part of it is social license in Canada, and that's not nothing. You know what I mean? You might, if there's more wildfires or if the world keeps warming, in 5 years, You might have a government that has more pressure, and they don't want to start from scratch, maybe with the new government that says, you guys have done nothing for 5 years. We will never trust you again. They can just say, no, we're continuing to improve. But I have heard, I did wonder after Trump and after everything, ESG, and I know everyone stopped caring about that. That is a true fact. If the tune would change around here also. And it really hasn't. Like behind closed doors, these guys are still saying we're competitive on price, but we're not competitive on carbon. So however they market, however, these are business decisions at the end of the day. I just don't think these guys are stupid. I don't think they could all be stupid. And I'll say this, if for some of you guys who follow Canadian oil and gas, if Murray Edwards, thinks that there's a case for this, the most profit maximizing, person in Canada, the most, efficient allocator of capital, then I will tend to trust that Murray Edwards knows what he's doing in this space.
It's interesting. Like one of our friend of the show is Doomberg there, that, he's written so eloquently that it's his view that many of these oil and gas companies are effectively technology companies. Just the amount of technology that they're investing, through carbon capture and through, excess production, et cetera. So I always find that like an interesting frame of reference, but.
Yeah, I don't know. They're still doing it. They're still pushing it. They're still negotiating. But at the end of the day, they will have to have a deal that their shareholders will tolerate. So I guess we'll see.
Can you walk us through that? Like, how does that look moving forward? So you're saying, listen, like, we're 2025 today. We're at the end of 2025. You're like, listen, like the pipeline, probably should come, but it's probably a 2030, 2031 story. Like, walk me through kind of like the next like steps. Like, it's obviously a very long process. Like again, 2030, of course, like, might not even be Carney in power, right? So what does that look like? So Danielle Smith's going to do some work behind the scenes. She's going to go out there and try to get one of the private sector companies to basically raise their hand and say, yeah, we're good to go. Like, what does that look like over the next?
Well, exactly. And again, I just remind everyone, that we have, probably 800,000, 900,000 barrels that we can still fill now with what's been announced now. So we have several years of growth in front of us. People will be looking to grow and expand. So so no one needs to panic right now. The sector is going to grow, and natural gas, there's lots, like all the LNG projects, they'll probably get FIDs. It's going to take a lot of capital and a lot of work and a lot of labor just to fill up that oil and natural gas demand that we already have in front of us today. So, but we are looking to the next decade. You can't plan pipelines when you're already got your back up against the wall with no egress. So if I were looking at it, and I'm optimistic, I would say 2031. So it's 2025 now. Danielle Smith has discussed a number of pipelines that they're going to act as a proponent. They'll have a submission to the Major Projects Office, I think in the first half of 2026. I've heard, there's April 1st number, there's a July 1st, 2026 number. And they will start on that early due diligence of consulting with Indigenous nations. And so there is no project, there are no impacts on rights yet. So now is the time to start these conversations, and they have started, by the way, those conversations. So, and then they can figure out the route, and they have the Technical Advisory Committee. They've already announced it, and Enbridge and Trans Mountain and South Bow are all on the Technical Advisory Committee. And Danielle Smith said just this week on Brian Lilly's podcast that she expects either a private proponent or a consortium to come forward next year, earlier, not later in the year, but earlier in the year, with a private-led proponent proposal. And the MOU specifically says that this has to be led with a private proponent. They would not have put that in there if they didn't think that there's a private proponent that has some interest in this. And so how will you make this appetizing for a private proponent? Which a $34 billion pipeline is not where they're going to allocate their capital. If you can get on that C5 list and you say, it's nation building project of national interest, 2 years, Alberta is backstopping it. And if you layer on the capital stack, Indigenous equity, if that's how you backstop it, if that's how you de-risk it, if that's how you bring some capital in is with, let's say, $10 billion Indigenous equity stake, then I feel like you have a really good case that it's all starting to fill in together. And we can talk about like the Asian demand, but that to me is the prize. Asia is the biggest energy market. It's the fastest growing energy market. The Pacific Basin is undersupplied, and you see where oil supply is going in 5 years when shale starts to peak, when all these other providers start to come down, and that's why, Rich, the Canadian oil and gas sector is already decoupling from WTI because everyone can already see the writing on the wall that will soon, in probably 4 or 5 years, be in undersupply, not oversupply as we have been. And I'm telling you, at $90, that pathways is not going to be a big deal, especially if you kind of amortize it over a few years.
So can I just so you mentioned a bunch of stuff as usual. We love you. But just like one thing I thought was really interesting, you mentioned about the lack of supply. I'm under the impression that the reason that supply crunch is coming is because of the ESG and green policy that have basically disincentivized companies to invest in all kinds of oil and gas pipelines, exploration, everything, the litany of different projects that are available. I mean, I've made the joke before that green energy policy is the greatest gift to oil prices. And so can you just explain to us like how the CapEx spend has deteriorated over the last few years and why that is such a big problem going forward for, the globe, I guess?
Yeah, well, I'll say, so the ESG focus really started after Paris Accord. I just want to give the historical context. The Paris
Yeah.
Agreement in 2015. What else happened around 2015? The shale revolution and the oil bust. That was
Yeah.
2015. And so it was so easy if you're a financial manager to say, we're going to go into tech and we're going to go into, EVs because there was no money. There has been no money to be made in oil for like the last decade, overall. It has underperformed and mining as well. So it was a very easy choice to say, oh yeah, I'm going to stick my money in ESG funds because it was roughly what you would have, where the money would have gone anyways. It's a lot. So it's going to be, and so it was starved. Some of it was that there was oversupply and overinvestment in the last commodity cycle. And those shale producers really did not provide good returns to their investors for a long time. Why would you keep dumping your money into shale when it's not really pulling a lot of money out? It's just sinking prices. And so it wasn't attracting. But then there was the ESG side, especially for non-OPEC producers, obviously, where there was pressure. They were pushed. Some of them did, as you said, Rich, not because an oil company has a good idea doesn't mean it's always a good idea. Shell, BP, all this money that they put into renewables, they lost money. Their stock has not done well, and they were now pivoting, so back to petroleum. It was beyond petroleum, now it's back to petroleum. So it definitely an underinvestment, and you can look. It's easy to Google, capex in oil and gas. Looking at a 15-year timeline, and you see the big, peak in 2010, 2012 in Canada. The peak was 2013, 2014. That's when all that oil sands money came in, and then you get too much supply, and then you have the bust. And now we're coming a little bit back up, but probably certainly not as much as we were last time. We've added 1 billion humans. Those billion humans, by and large, consume more energy per capita than they did before. So the cure for low prices is low prices. We have been underinvesting. OPEC has been warning about this. Everyone's been warning about this. And Canada, meanwhile, has just been lowering its costs the whole time, lowering its costs so that it could really break even. If WTI was $40, they probably wouldn't be shutting for production. Depends on the source and the company and the play, but somewhere around $40, $45, these guys aren't shutting in production yet. And we saw that with COVID, that, they were really, kind of the first ones to bring production online and the last ones to take it off. So it's just such a bullish setup for Canadian oil and gas, that we are, the only large democracy that has these long life reserves. Mexico is probably has probably seen peak oil. Norway has probably seen peak oil this year. The United States, it's still hitting new records, but one of those records is going to be peak, very soon, I think.
I got just so on this Permian Basin, because a couple of years ago I remember reading about Permian Basin's peaking, and then lo and behold, as Steve has mentioned, the engineers come in and they work that Rubik's Cube, and boom, there's another leg up. And so, are you not a little bit skeptical that's just happening? Not going to happen again, where people are saying, "Oh, the Permian Basin's peaking," and within a couple of years, some enterprising young man or woman is going to come up with something really clever to squeeze just a little bit more out of that area.
I mean, they might squeeze more in. Some of the basins have already peaked. So you can see
Okay.
what the curve is. You
Okay.
know, it's not unknown. Some of them have peaked. And everyone knows the Permian's getting gassier. And it's, you know, you're getting more of your oil in a faster amount of time. Like the treadmill is going faster. And anyways, you know, it's shale producers themselves are putting their money elsewhere. The reason
Okay.
why the Canadian Oil and Gas Index is outperforming is because some of that American money is starting to look for other, you know, tier one inventory or whatever. So the money
Okay.
thinks that shale is peaking, shale
Okay.
oil.
Heather, I want to come back to the discussion on this pipeline because, of course, one of the largest proponents, against it, effectively, has been David Eby, where I am here in BC, and so there's two things to it, which was one is he says, and you said, you know, you listen, you have to have some First Nations buy-in and you know have some equity stake, and he makes the argument that there's no, you know, the First Nations or the coastal First Nations are against it. Can you kind of unpack that, the truth or
Yeah.
sort of
Well, I'd be happy
non-truth
to
to it?
because I mean, I've seen this movie before, and I closely watched this movie before, and I'm talking about Trans Mountain and Coastal GasLink, and how I'm just gonna say people were, you know, gaslit. Politicians and media thought that all Indigenous peoples are against oil and gas development, and there were protests and the hyper focus on those who are against. And then it turns out, and you know, this is now history, that, you know, both of those pipelines got built with majority Indigenous participation, and they're both operating safely. So I just feel like I've heard this before, and then EB in particular, and it infuriated me. Like to this day, I will get upset about how during the Wet'suwet'en blockades and Coastal GasLink, Indigenous peoples were instrumentalized by the environmentalist movement, by left-leaning progressive politicians to fulfill their agenda. That they were used, they were put out in front of the TV, you know, and pushed into a particular position. And a lot of BC First Nations called that, and I'll say that that was eco-colonialism. That is a term that is used. And is it true that some First Nations are opposed? Yes, it is true. Do I think it's most or majority? I don't think so. I think it's a very difficult issue. I think there are legitimate concerns about oil spills. I think there are ways that Canada could develop a fantastic pipeline, as we did with Trans Mountain, that could, you know, reassure nations that it's safe. You could include them in the monitoring. You could include them in you know, the response, all those things, so that they trust the process because they're part of the process. We did this in worse circumstances 10 years ago. So it's hard for me to believe that we can't figure that out in 2025 when technology is better. There's more Indigenous communities that are equity participants and all those things. But anyways, to your point, EB trotting out. You're hearing Chief Stuart Phillip from UBCIC. His community's not on the pipeline route. You're hearing the Coastal First Nations, capital C First Nations. It is an organization, a nonprofit organization that was established by the David Suzuki Foundation. That's right on their own website. That is not a conspiracy theory. That's in the About Us. And they are not on the route. You could argue that their territory will be impacted if there was an oil spill, but it is not through their territory that the pipeline or the port is meant to go. So when, you know, so I'm waiting to hear from the ones along the route and the ones around Prince Rupert and the ones all the way up to the Alaska border, and see how they feel all about this and what negotiations, what incentives, what commitments on the environmental side could change their mind.
And is it true that obviously you want to have those First Nations buy in, you want to have them be equity partners, but is it true in theory that the federal government effectively has the full power here to basically just jam it through?
So there's a constitutional duty to consult and accommodate. And we know almost exactly what the threshold, what the requirement is, because this was the jurisprudence came out of Trans Mountain. Where it was, you weren't quite sure what duty consult accommodate was. There was a lot of law cases and a lot of judgments, which have now clarified. And it's pretty much, you know, is pretty settled, the law around that. So on almost the exact same case, we know what, we've had these cases, these arguments, we know what it is. The Crown must act in good faith and seek to obtain that consent. But there is no veto and there is no requirement to get the consent. You need to accommodate impacts on Aboriginal and treaty rights. I'm confident that we can build a pipeline that accommodates and mitigates and reasonably compensates for those impacts. And I have to point out that there is a reciprocal duty on the Indigenous nation part to also work in good faith, to advise on solutions, to be specific on what the concerns are, to look for solutions with the proponent on how you could mitigate those impacts to those Aboriginal and treaty rights. So we actually have a pretty good idea of what needs to be done. The politics is maybe different from the legalities, but we just, you do need to consult in good faith. You do need to work towards solutions. You need to fulfill the honor of the Crown. But we have done this with pipelines again and again. And we have 840,000 kilometers of pipelines. You're talking
Great chart.
you're talking about adding another, 1,000, 1,500 kilometers. Like it's not, we have built pipelines before.
Just so on, go ahead, Steve.
Go, Rich. Go ahead. I gotta.
Yeah. Really quick one. Sorry. Well, maybe it's not a quick one. It's meant to be a quick one. Just on the coastal stuff, can you just quickly just clarify this whole tanker ban thing?
Yeah, okay, that was my question. While we're on the topic of fact or fiction, basically.
Yeah.
Let's unpack this tanker ban, because you've got EB coming out now saying I'm all fine. I'll be pro pipeline, but only if the tanker ban remains in place. You've got former, Premier Christy Clark now coming out doing media interviews saying, listen, the U.S. tankers are going up and down the coast already. What is, you got Elizabeth May who's making, weird videos
but also there are tankers that go to British Columbia's coast right now, surely.
Listen, if you ask me, the whole, the Great Bear Rainforest and the tanker ban is all created to stop a Northern Gateway-like project from proceeding. And it was literally passed C-48 the same day, received royal assent the same day as the Impact Assessment Act. This all followed Trudeau's rejection of Northern Gateway. This was a way to codify the inability for some other proponent, this foolish proponent, to come back and try to build this pipeline to the Northwest Coast. There is not a good scientific basis for it. There's not a good environmental basis for it. There's not a good legal basis for it. And people, this was a very emotional issue in 2018 and 2019. There was so much frustration and concern. This is when people were protesting in the streets, and the government was going to pass this moratorium. And the Senate, which is very unusual for the Senate to do, said, hold up. We need to look into this. The Senate held hearings in Prince Rupert, I think in Kitimat, or, wherever they were in Northwest BC. They took a road show to talk about this oil tanker moratorium. They came to Alberta also. And they voted, the committee, that's the Transportation Committee, Senate Committee, voted against it. They did not pass, but then eventually the whole Senate, they had a bunch of recommendations. Paula Simons, Senator Simons, who is, a progressive senator, Alberta, former CBC journalist, voted against it, said that she, they hadn't done the work. There wasn't the evidence, the research that wouldn't lend itself to some other less severe, solution than a moratorium. And so if you look at the science and you look at, what can be done, the technology, the mitigation, sure, if your lens is, I accept zero risk, okay, then you need a tanker ban. But that's not how a functioning society works. You won't have any port. If you're
or anything,
you won't have anything. I won't be able to drive my car, to the grocery store.
Right.
Except zero risk. And it's not under the law. It is not a reasonable thing to say we can only accept zero risk. Anyway, so there's we move millions, tens of millions of oil on water around the world every day. We move it out of Vancouver. We move it into the East Coast. The oil is getting moved on water
through the Great Lakes.
Through the Great Lakes, and also oil and hydrocarbon products to all those communities in that oil tanker ban, because they need it for their own use. They are dependent on diesel for their own, civilization. So it is just, for me, it is absolutely about stopping a pipeline from exiting out that coast. That is what it is about, bar none.
Can I just ask another really quick dumb question? I mean, people still have, I think, the Exxon Valdez disaster in their mind, but fundamentally, these tankers are just wildly different creatures. I mean, they're not at all one. I mean, none of the boats that were built, I imagine none of the boats that were around 50 or 40 years ago is what we're talking about now. I mean, the boats that are traveling on the water are hyper sophisticated vessels that have double hulls, and I mean, right? I mean, they're just completely different pieces of technology.
And you can have standards, and you can have tugboats take them to where the water's more open. Like, I'm not a marine expert, but I am so confident that this can be done safely that you like go ahead and say we're going to have the highest standards, out of the Dixon entrance. Yes, I'm totally fine with having the highest standards, but the threshold can't be like, zero risk, nothing can ever happen. No, the technology is obviously much better. And, as a drunk captain, there's tremendous liability. Like, no one wants to assume, insurance companies don't want to insure things that are going to, force them to clean up the oil spill. So it's just, it's a debate based in emotion and ideology. It's not one that has been based in science and the law.
So while we're on the topic of Team Canada and elbows up, Nutrien recently announced they'll be exporting their potash out of Washington and not BC. I'm kind of curious what your thoughts are, how this happened. I mean, Scott Moe's comments in the media just this week says, quote, when someone makes a decision not to invest in your area, you should look in the mirror, not blame others.
Yeah. So yes, agree with all that Scott Moe has said about this. And this is, again, Canada's wealth is concentrated in Western Canada's resources. And the biggest consumer of raw materials is in Asia right now, and that is going to grow. And it's
like, sorry.
And we just get these resources of this half of the country to that enormous 4.5 billion person mark. And it is BC that is saying, is a small slice of Vancouver you can go through, and a small slice of Prince Rupert you can go to, and not for all products, by the way, certainly not for oil. So this is very frustrating. But I'm glad that we are having these conversations, because people should know, like, why haven't we been able to double, exports? Why haven't we been able to reduce dependence on the United States? Because it is very hard to export these products through ports in BC. And the federal government has made it very difficult and very expensive to build out these things. The labor unions are, it's federally regulated. We've had problems with the labor and rail, both rail and port, for decades. They don't have these same problems in other, Australia, United States. They don't have the same comparable problems. That is a politically difficult thing to tackle blue collar union workers in BC, but they are absolutely holding us over a barrel. And it's not just, it's not just oil, it's not just potash, it's agriculture, it's metallurgical coal, all these things. So I have, Nutrien made the best decision for its shareholders and for its return on investment. You cannot expect Canadian companies that are publicly traded to make their decisions based on our nationality.
How dare you?
You can't, because they have a fiduciary duty to their shareholders. That is their duty.
I agree with you, of course,
yeah.
But
So what is our recourse here? Be more competitive. Make them want to choose BC instead of Washington. And so that's, so it's too late, I think, for Nutrien. But let's at least, now that we have our eye on the ball, let's look at what has prevented a company like Nutrien from investing $1 billion into BC. And what was it that David Eby didn't even know this was an issue on the table? Nutrien announced that they were looking at ports along the West Coast in the United States and Canada in May. And Eby said on Sunday that this was the first. He had no idea there was even the prospect of this happening, and the federal government didn't tell him.
That's obviously bullshit, though, right?
Yeah. I think the worst explanation is that he didn't know, Richard, that BC didn't even have $1 billion investment on their radar.
Crazy.
Well, I was reading here, and there was a new report that ranks Vancouver as the world's least efficient ports. It ranked 389th out of 403 reviewed.
Come on, that can't be real.
This is according to the World Bank's annual Container Port Performance Index. Rich, you got to start tracking that one.
Yeah, I do.
Yeah, I don't know. I mean, I don't know again how much validity there is to that, but
it's very inefficient. And this is, if you're Nutrien, you don't want to be caught in the trap of, if there is a labor strike, that you want to have optionality. You want to be able to divert from multiple ports, so that you have some redundancy. So you're not stuck with only Canadian ports that will be entrapped in labor strikes.
I was also reading, I don't know if you knew this or not, but it says one of the biggest problems facing agribusinesses is that Vancouver is one of the few Pacific ports that bar loading grain onto vessels when it rains. Because it rains 165 days in BC's Lower Mainland, the ban creates scheduling nightmares that during winter can snarl supply chains.
Yeah, I don't like in Saskatchewan. People in Saskatchewan talk about rail and labor issues in Vancouver a lot. You'd be shocked, but it is in many, like, it costs them money. It costs the personal individual farmer money. It makes it harder to market their food. And it's like, what is going to shake us out of our complacence? How did we actually not all know this before the last 2 weeks? How was that not already? There was an inquiry on this in May. The federal government didn't.
Heather, let me correct you. It costs Canadians money.
Yes. Oh, yes.
Because
yes, it does. Yes.
It's not just Saskatchewan. It costs Canadians. Think about all the royalties, the taxes these companies are paying. I mean, anyway, sorry. I think that's we often get bogged down and siloed of each province. Quebec's bitching about oil pipelines, but obviously they need oil, and I want to ask next time, maybe I'll ask you about the East Coast, but it just costs Canadians money. But I know we're running up against the clock, but I really want to just get your view. Do you see a memorandum of understanding coming through with respect to critical minerals and rare earth stuff?
Listen, this is going to give me the opportunity to give the Carney government and even the BC NDP some credit. Because there's been a big shift on LNG and mining in the last 12 months. And if I'm LNG and I'm mining, I'm actually pretty happy, and I'm feeling pretty good about getting some investment. And so LNG, obviously, all those projects are approved now. Silicium's and LNG Canada Phase 2 and are approved, and we're waiting FID. Cedar's under construction, Woodpiper's under construction, LNG Canada Phase 1 is operating. There's a lot of room for growth. It's a great sector. And Carney and EB have both gone to Asia and obviously have been trying to attract investment. The budget made some good moves on LNG that I think Asian buyers are going to be satisfied with. On critical minerals, this is a popular topic. It's not hard to be pro mining in Canada right now. The government made some good changes in the budget. I think, probably 80% of it was written by the Mining Association of Canada. So, how can you complain about it after that? And also the Critical Mineral Alliance through the G7. And so they have a $2 billion sovereign, wealth fund. They're going to be counting it as defense spending for NATO in some cases. They've made some investments. They've done some stock, offtake agreements. And the commodity cycle is also looking good. Gold, silver, uranium have already run. Copper's looking like it's very much next, which is great for a lot of producers. So it is good times in the cycle for Canada to be giving these signals. And the last thing I want to say, because this really flew under the radar, we all hate C69, the Impact Assessment Act. If you're a business association, what you've been asking for is one project, one review, and ideally one decision. Last week, the government announced its cooperation agreements with Manitoba and Ontario, which goes quite a lot longer to say the feds are staying in their lane, they're getting out of the way, they're deferring to those provinces on as much as they can defer to those provinces for. I'd love to see that across, for each province, but they're working on that. But which is to say, if you're a miner, it looks like there's going to be less federal interference in your application going forward.
Your overall, it still depends on, of course, the execution, but the thinking and the conversation have shifted dramatically. So it's fair to say you're optimistic about, the last couple months in the natural resource sector.
In the natural resource sector, and I can hardly keep up with the good news on nuclear, on mining, on oil, on natural gas, on LNG, this MOU. I can barely keep up, and you can say, oh, it's great, there's public opinion has changed. Public opinion is changing because the commodity cycle is changing. That is going to be my conviction, is we can all see the money that is going to be made. It's too much to leave on the table. And so the policy is now starting to orient itself to take advantage of where we are in the cycle.
I think it's fair to say when Stephen Guilbeault steps down, that's usually an encouraging sign that we're moving in the right direction.
I don't mind being petty about this particular topic. There's some polling that just came out today from Abacus about
this is a safe place. You can be as petty as you want.
And he's universally disliked across Canada. He has a net unfavorability rating of -31 in Alberta. There's not even an orange NDP that is going to be sad to see the backside of that guy. Good riddance, au revoir, adieu. That person cost the Canadian economy tens of billions of dollars and made a lot of people's lives worse because of his commitment to his ideology.
That's worse than Rich's rating. Well, Heather, I want to thank you so much for once again taking time out of your day to come on the Loonie Hour, and hopefully, I feel like so much of what you're putting out there on Twitter and then even coming on the Loonie Hour is helping shape the conversation in this country. And so, I want to thank you so much for that as well, because I think it's important to have voices like yours that are out there and actually willing to sort of speak up and. Yeah, I mean, we're just very grateful to have you on the show and look forward to hopefully having you on again in the very near future. Well,
thanks. I always say interest in my policy research is a very bullish indicator for the commodities sector.
I love it. Heather, what's your Twitter handle again?
At Exner-Pirot.
Okay, that's a must follow. So once again, Heather, thank you so much for coming on the show, and we'll see you again soon.
Thanks, guys.
Another great conversation with Heather. Hopefully everybody enjoyed that. Again, I highly encourage everyone to check out her Twitter feed. We're working on a whole bunch more guests as we get into sort of the holiday season, the new year, where the news cycle tends to be a little bit slower, but we can actually sit down and have some really good in-depth conversations. And we've had a lot of people talking and emailing us about the Doomberg episode that we did. Was it about a year ago now, wasn't it? Just before the election.
Yeah.
It was before the election. It was before
that. I think it was
but it's seemingly like everything that Doomberg was chatting about around like Mark Carney, the election, the Alberta pipelines, it all seems to be sort of coming to fruition. So it's been quite illuminating. People have he's one of our most highly sought after guests now, so we do intend to bring him back on in the very near future. So we'll again announce that shortly. But lots happening in the Canadian energy space, lots happening in politics. It's going to be interesting.
My takeaway from Heather's commentary was she was overwhelmingly positive, I would say, cautiously optimistic. Maybe that's the phrase of the day. I think her views on how the difference in tone is fundamental to unlocking domestic and foreign capital, and I really appreciated her dig at not friend of the show Stephen Guilbeault towards the end, and the fact that him being ousted, I think, is really tells you a lot. It tells you that he collected his pension, and it tells you that there's a massive shift in tone with respect to natural resources in Canada, and clearly that the commodity cycle is turning our way, and we should take advantage of it. But I think that's the way I would sort of describe her comments.
So
it's interesting.
Now, go ahead.
I wasn't in the conversation, of course, but I had a similar conversation like this with someone else yesterday. And so with Carney, the team basically doing the 180, I would call it, or a U-turn.
Yep.
And I compare this to what Bill Gates did recently. Remember, he came out with a letter to do a 180 on his climate change view. And, there are some some people are speculating why he did that, but that could also be tied to the whole energy sector as well, because he has a lot of money now pushing into the AI space, which is just going to gobble up so much energy that's coming up. So maybe that, and then you have the Carney move as well. And they're all from the same sort of globalist kind of group. So this is really interesting. Maybe this, Bloomberg will come back and say, yeah, this world has now pivoted and this is where we're going next.
Yeah, so it's interesting. Just there was actually a poll out today from David Coletto, who runs Abacus, so one of the sort of leading pollsters in Canada, and he shows the reaction to the memorandum of understanding by region. So he basically shows net support by region. So BC plus 23. So again, positive support for the MOU in BC plus 23. Alberta obviously plus 63. Saskatchewan, Manitoba plus 47. Ontario plus 47. Quebec, even at Quebec, is plus 16. So then you have Atlantic Canada at plus 38. So overall, Canadians are in support of the memorandum of understanding. So there you go. We'll see.
Sorry.
Usually we're talking over each other.
Yeah,
now we're waiting.
What's we always get in trouble for talking over each other because of the damn lag on the Zoom, and then this time we didn't. I think that's the first time that it's happened in 217 episodes.
Feel free to chime in, hey, whenever.
Okay, that's great then. So now all of a sudden in Canada, we have some momentum on the commodity energy sector. And let's see if we can keep the momentum going. But it still has to be strong enough underneath to attract foreign investment coming in. I mean, that's the key with it. It can't be government money. We want the private sector wants to go that route. So what else, Steve, do you have lined up for the rest of the week?
I mean, we've got a pretty busy couple of weeks here for central bankers coming up. Mm-hmm. So we've got the BOC next week, Rich.
Yep.
What's the date again?
Uh-oh.
The
date. Oh, my computer. The 10th of December.
10th of December. Do you know what market odds are currently?
I do. 92%. No change.
No cut from the BOC.
No cut. Yeah.
All right. Well, should we set that?
92.03 just for Keith. I know he's curious about the second decimal.
You've also got you got the Fed. You got the Fed next week, and I think the following week you've got the Bank of Japan, the Bank of England, the ECB. So you really have, the five. What is it? Five? Yeah, five central banks there. I mean, there's a couple more, Keith, that I might have missed out. But
I thought you were going to say the five major central banks of the world, but I don't know if Canada is within.
No, I know. I caught myself there because they are definitely.
But we're the G7. We're the best in the G7, Keith.
Yeah.
Is the Aussie central bank up too? No.
The Aussie central bank's up too. Yeah.
Well, let's come back to the Bank of Canada meeting. So, I mean, it's a Twinkie bet, of course. So I'm down for no cut. I don't think they're going to hold. That's my.
I mean, I don't think you can go against those market odds. So I'll go with the hold too.
You cowards.
Rich is calling for a hike.
I want odds.
Points.
I want odds commensurate with the probability. So if they do cut, you guys have to eat 10 Twinkies. No, I'm not. I mean, I'm just joking. Obviously, they're not going to cut. 92% is de facto.
Keith will go into cardiac arrest if he has 10.
Yeah, absolutely. But let's talk about why there's no cut. There's no move next week. I mean, that's probably more important for the audience. Yeah. So before in the previous meeting, there was a cut. That's where we went with it. And now that we're at the point where, economic data, again, it's kind of, it's not accelerating. It's not declining rapidly. Well, Rich will fill us in on the GDP number that came out a few days ago. The headline number looked really strong, but if you tear it apart, it wasn't that great, really. So this non-move by the Bank of Canada, it does make sense. It would be incredibly more alarming if they did cut next week. And the fact that the market is saying no cut, they're not going to do that because that will push banks off sides with their balance sheets, how they're positioned for it. But that's, it's, hey, looks like we're going to survive to year end or till Christmas time anyway. Or anyway, it won't be, if something does get triggered here, maybe it will happen after the Bank of Canada meeting, and then we can blame it on, the Brits or the Europeans or the Japanese, something like that. But Rich, do you have any thoughts on, why they're on hold at this point?
Yeah, one is kind of a dumb thought, but I'm going to share it with you anyway. That's never stopped me from before, which is just that inflation is at target. It's 2.1. Headline inflation is at 2.16%. And we know that core inflation, let's just take the average of the three preferred measures of core inflation, is at around just under 3. And I think most importantly, the reason why they're not cutting is because it's not going to solve what ails Canada. And I think that's what they literally told us that. And I think, although I've been extremely critical of the Bank of Canada during COVID for gobbling up all that government bond issuance and for obfuscating inflation, et cetera, et cetera. I think they were right to say lower and lower rates is not going to cure what ails Canada, which is, again, productivity, capex, regulation, taxes, blah, blah, blah. And I think that they recognize that I think that's it. And they said it, and I think they recognize it. And I also think the other thing, and the last quickly, is I think they want some, what do they call it? Dry powder, to quote our favorite ex-finance minister, Chrystia Freeland, that in case something does go wrong in the future, that they can, they can cut to soften the blow from an external shock. That's the way I would describe it.
So no cut.
No cut.
Is the market pricing in any still pricing in 0 cuts in 26?
Actually, the market is starting to price this like a small probability of rate hikes in the very future. But I think that's sort of noise. I don't think we should pay too much attention.
Scotiabank's Derek Holt is calling for hikes as of, I think, the back half of 2026. He's been kind of the outlier, though. Like he's been right. I mean, he's been right. I think right and wrong. I think he missed the dismount, but
so I can tell you the exact numbers. So December. So there's a meeting on December 9th of 2026, and there's a 17% probability of a hike and a 20% probability of a cut in December. And what that really tells you is no one knows. Like the market doesn't know.
So far out.
Yeah, it's so far out. A lot can happen. External shocks from France, UK, Germany, China, etc. I think what it is like these markets are not. We use them as probability distributions, but they are de facto ways that banks and hedge funds and other pension funds and institutions can effectively bet on the movement of interest rates. So, when you do have that distribution, 20 cut, 60% no cut, and 20% hike, it's not meaningless. It just means that there's no real direction.
Yeah, so let's talk about. I mean,
but
part
just
of this
to add on, Steve. Now I'm talking over, of course. The big vacuum with no one talking. Now we can't wait. But the further out you're looking in time, the less sort of volume there is in these contracts. So you don't put any weight hardly,
right.
12 months out. It's really like 3 months out. That's 3 month rolling period. That's where you get because that's how banks then can take positioning with their balance sheets with it. So what is it calling like there's a meeting in March, I assume, Rich?
Yes, sir. So March 18th, there's a 20% probability of a cut. And then April, 20%. So so nothing. Yeah. In my view, that's the way I would interpret.
Okay.
So part of this, of course, is GDP. There's been a recent, it was last week after we recorded the pod, but GDP came out. So third quarter GDP showed a surprising positive 2.6% annualized headline number after, of course, a weak second quarter. So the estimate, of course, GDP grossly surpassed estimates. Rich, what was your takeaway there? I mean, there's a lot of nuances in that 2.6% headline.
Yeah, I mean, so just so people understand, they use the GDP, they use the expenditure method, which is so GDP equals consumption plus investment plus government spending, and it's plus net exports. Okay, so in brackets you have exports minus imports, and so what we saw from the release is actually that household consumption actually was negative. And the big contributor was a decrease in imports. So that's like a double negative. right? So even though GDP grew because of the way the formula is set, it was actually what it was a retrenchment in imports. So less imports is positive for GDP. I know that's a bit confusing, but that's just bear with me. And there was less final consumption in households. So it was okay to not great is the way I would describe it, even though the number was positive. Does that make sense, or did I really?
Well, I'm
did
just
I
curious
gobble
if
that?
I'm assuming there's less imports because domestic demand is weaker.
Exactly.
Is that a fair assumption?
No, it's because of tariffs and the president. No,
No,
Rich is right.
it's all of it.
Exports were roughly in line with what they were expecting, but because they imported less, it was a bigger contribution. The other thing with GDP is measured quarter over quarter. So because the headline number was really strong for Q3, it likely means Q4, the one that currently in, is going to be weaker than expected than at the beginning. So so whenever you get a blowout quarterly number, either on the high side or downside, a lot of that can get offset in the next quarter, unless there was a very significant change in trend. But I think everyone knows in Canada, and Steve, we were talking about this, I think earlier, we talked about the K-shaped economy. This plays into it. We are seeing, there's a part of the domestic economy, not just in Canada, but for the Americans as well, and across Europe and everywhere. There is a part of the economy that is really struggling, that's not doing well. And that stuff will get picked up in domestic spending and consumption. People moving down the food chain, in terms of which grocery stores to go into and what they're buying and things like that. But this GDP report, it is suggesting that, hey, nothing has recovered here at all. It's still a struggle out there.
So there's a good note here from friend of the show, Ben Rabideau. He says that was the first non-COVID decline in household consumption since 2009. So if you can kind of ignore COVID, it was the first decline in household consumption since 2009.
Yeah.
So
it's also to do with so obviously cars are a big chunk of household consumption. It's probably the second biggest purchase. After you buy a house, you're going to buy a car. And a lot of the purchasing activity was brought forward to the beginning of the year. I think actually that was
our guest. We had our guest Brian there that a couple of weeks ago that he mentioned, which kind of surprised me, right? Canadians effectively front running the concern around tariffs to go and buy a car before prices went up.
Show me an incentive and I'll show you a result. Consumers are extremely smart with their own money, unlike governments. And what you saw in the release, they split out. They say that there was a big drop in so household final consumption fell was 0.1%. As decreases in spending on passenger vehicles, negative 0.23% was offset by expenditures in rent, etc. So it was just like, you brought forward your consumption, and so that's why Q3 was weak in that specific area. But in general, not great.
The long story short, fade the headline.
Yeah. You should always be suspicious when, I'm sorry to say this, when politicians tweet the release and don't put any context to it. And that's of course what we got. Remember when Chrysler Freeland picked the bottom in the inflation? That was so funny. God love her. That was amazing. And I think that we're sort of seeing the same thing in this time around.
But that's a part of this whole sort of, gotcha culture that's out there. And I really dislike that kind of reaction. But so again, everyone to take away, hey, the number looked really good, but underneath, smart guys out there, smart people are looking at it and saying, okay, we have to be a bit concerned here. And the number that Ben shared, I didn't realize it. It was the weakest quarter over quarter since 2009. That's Loonie Hour math. What's that?
Outside of
years,
COVID.
9 years?
Outside of COVID.
Yeah, of course. So, Steve, why don't you introduce the K-shaped
we had, so there's a lot of big banks reporting this week. We're not going to get into the nuances of all these banks. I mean, earnings are coming out better than expected for a host of different reasons. But there was an interesting commentary from RBC. I think their stock just hit a new all-time high today. But the CEO, Dave McKay, expressed cautious optimism on the wider picture. He says, while the operating environment remains fluid and complex, and there is a lot of hard work yet to be done by governments and the private sector, I'm cautiously optimistic on the outlook for Canada. However, he says the impact of the K-shaped economy is increasingly polarizing, with more affluent consumers investing disposable income and growing markets, while less affluent consumers struggle with affordability. So that's kind of, pretty interesting commentary from, the CEO of Canada's largest bank.
We've talked about this before. I've made this point, not in those words, not as eloquently, naturally, but I've said, people talk about race, religion, color, creed, age, whatever. I think the real bifurcation, the real fault line in Canada's economy is, do you own your home or do you not own your home? And even though we've seen, and to me, that's where I think, in my view, that's where that K-shaped stuff comes from, because you've had this massive run up. Yes, house prices are down 20%, but you've had a massive, massive run up in house prices over the last 10 years. And if you own your home, you can basically fund your lifestyle basically on the massive increase in equity at extremely low interest rates. And if you're outside of that space, if you haven't been able to been attached to this basically asset boom, both in equities and in houses, I think you've been left out. And I think that's my perspective on it. I don't know, Keith, if you have a different view.
Yeah, it's the same thing. I'll say it better, but but what the K means, of course, the letter K, you have one arrow, one line is pointing upwards. People in not just Canada, but elsewhere, if you've accumulated wealth, whether it's in your house or whatever else you have, and you have very little debt and you have still money pouring in, I mean, you're having a nice life still. Like, nothing is biting at you that much, and you'll continue to always spend and enjoy life. Then you have another part of our economies. Those households do have a lot of debt. Their income is not growing as much, and it is like the arrow is pointing downward. That's why they reference the letter K when they're doing it. And central banks, I mean, Rich, again, you talk about this quite a bit, when they cut rates, or we have what I call this lost decade from 08, 09 up to 22, really. When without rates going higher, they're doing that to try to stimulate the economy, they try to bring lower household incomes up, but really you're just inflating the upper side, the higher tier or echelon for people who are wealthy. And there's no way to resolve this. It's just a function of way the economy works and capitalism works. But the political side will always follow one line over the other. And it's here we are. I mean, it's just a function of the way things have moved.
So let's jump gears to the other central banks, Keith, which of course have a heavy influence on the BOC. You've got the Fed next week as well. And then following that, I believe it's the following week, you have the Bank of Japan, the Bank of England, and the ECB, all of which we've been keeping track of over the last number of years. But what's the expectations from the Fed? Keith, you've talked about the rising probabilities of them getting back into QE. There's, of course, pressure politically for them to cut rates. They're likely to have a new head of the central bank in the new year. What is the outlook like for next week?
I mean, for next week, markets are pricing them to cut. I think it's over 90%, 92, 3%, somewhere 85. In that line. 80, round it up, so it's 92%. But when you have a dominant probability of a central bank doing something, it shouldn't move markets because it's already expected. And so that the big story that's happening with the American central bank, that it's increasingly looking likely it's not as independent as what it's always sold to be. So I mean, you have the Treasury and the White House are now strongly influencing monetary policy. And even though they're trying to fight against it as much as they can, suddenly the data is getting weak and stuff. But underneath the surface, this is something that we talked about at the Investor Series event we had. People need to appreciate that you have to look at bank reserves. So that's just a collection of what the big American banks like JP Morgan, Bank of America, RBC's, version of their U.S. bank down the south of the border. They all have accounts at the Fed, and that's where they have to keep the reserves on balance really with the Fed. Then based on those reserves, they're able to lend out a multiple of that. And you extend credit to the economy, and that's how you grow. So if you go into a little branch on your street corner and say, hey, I want to borrow 25 grand to buy a car or to do whatever, the branch can only extend money to you if they have the reserves available, with the parent company and so forth. With quantitative tightening happening, as well as the economy not really growing as fast as what they would hope to, the reserves at banks have not been growing as, I'm not saying this correctly. The amount of reserves at banks have not been growing as fast as the overall economy. So the reserves as a percentage of the overall economy in the US have been declining. And while there's no hard line number with it, some studies are coming out that suggest that once you go below 10%, so all the reserves in the US banking system, once it drops below 10% of the value of the total domestic economy, bad things start to happen. And that's what happened in 2018. And then you go back to the housing crisis as well. You get these like extreme moments in time. And right now, as we talk, I think we're around 9.5 to 10 and a quarter, Rich. I think that's where it is. And, we talked recently how the Fed, they're going to stop doing quantitative tightening, because when they do that, they're actually taking reserves out of the system. So now we're at that point in time where the American banking system, they need reserves. As soon as reserves stop growing, that's when you can get a crisis in the repo market. So all of a sudden, banks become reluctant to lend with each other, or there's not enough collateral in the system to lend and borrow. So we're at this moment now. So for the Fed to start cutting rates, people may think, well, the White House has encouraged them to do it, or data is getting weaker. It's the same thing. Even if that didn't exist, bank reserves are getting lower and lower. So of course they have to start providing liquidity to the system again. So don't be surprised next week. You're going to get a question in the presser. When is QE starting? And they'll fumble over it, but everyone knows the answer. So if they don't do QE, they'll break the banking system.
Okay, so
and Steve, do you want to break the banking system?
Yes.
The answer is no.
No. Sorry.
Don't follow Rich today, everyone. Follow Steve. Steve was about to say no. You don't want to do that.
You don't do that.
So,
and if they do, but wait though, if they do QE and they're cutting rates, then they're going to start stimulating the economy again, and inflation is going to go through the roof, and then you have this whole K-shaped, economy thing. So do you want to have inflation blast off or break sort of the banking system? They can't win no matter which one you do.
Well, that was kind of my next question, right? Which is okay, if that is the setup, which is listen, there's a 93% chance of a cut next week per Keith's math. And you have, they're going to end QT, they're going to probably start up QE. It seems to me like you have a setup here that's bullish for risk assets. Assuming they actually can pull through with everything that we think they're going to do. So would that be kind of your takeaway? There's obviously some concerns about the overall economy and parts of the market, but in general, if that's the setup,
So the setup is for risky assets. That's the stock market, for example. Crypto is tied in there as well. I think equities can just go to the moon. But the question is, do they have a big correction first because of an accident? Or do they have this big surge now, which then sets us up for even bigger crisis, either a year from now or 3 years from now? You're not sure when. But again, it's one of these moments in time, because the central banks, they now have a lot of experience with it. They know exactly where this is headed with their balance sheet. Again, they have to build up reserves for the banking system. If they don't do that, something will break. And you never know what it's going to be. You don't know. And you don't know the after effects of it. So by default, they have to try to stimulate. And then by doing that, maybe they create something else. But again, it's really this, two-road highway. We know where we're going. It's just a matter of we get off the exit ramp first and then go higher, or we go higher right away.
So thinking, speaking of things breaking, why don't we shift gears to the Bank of Japan, who's on deck shortly thereafter from the Fed.
They're gonna hike.
Yeah, so let's chat about that.
A whopping. Sorry, I had the number here. They're expected to hike a teeny weeny. I mean, it says 25 basis points, but I don't believe that, Keith. Do you think they're gonna hike by 25 basis points?
I think we'll get more. I thought the BOJ would be a better conversation next week, just for the length of time that we have here today with Heather and everything. But this is now, we just set everyone up. The Bank of Canada story is a non-story, by the way. Like, it's the Americans next week. Mm-hmm. We touched on that, but the Japanese story and sort of the so-called end of the carry trade. This could be enormous. This is one of these events. So even if the Fed, so maybe this is happening at the same time. So the Americans are chatting with the Japanese, and they're saying, "Are you guys really going to raise rates?" And they're, "Yes, we have to raise rates." Like, you don't have to, but that's what they're going to do. And the Americans are saying, "Well, okay, in response to that, and we're a week ahead of you guys, then we got to cut. We have to provide liquidity to try to offset through this tsunami that's going to hit the world." If the Japanese, if they can hike and try to remain very dovish at the same time, but if they try to sound hawkish, it's going to create a big distortion. So the biggest distortion, what happens, the Japanese yen just appreciates aggressively against everybody. And then underneath all that, the dollar appreciates aggressively against almost everybody. Some of them will be a bit flattish against, but commodity sectors, they'll get hit really hard with this if it happens. So Canadian dollar would get hit, of course. But it's all of a sudden the Bank of Japan, Steve, it's turning into the potential year-end story. Is that your take as well, Rich, or something a bit different?
I just think I think the Japanese are kind of screwed, and you're seeing they're basically there's tap dancing now. And why do I think they're screwed? I mean, I think that the 10-year bond yield is about to hit 2%. And actually the 30-year bond yield is about to be higher than in Canada, which is really, I think, really fascinating. You're seeing the yen just continue to depreciate.
Just for context, for our audience following along, Japan's 10-year yield hit a 17-year high.
Yeah.
I think the 30-year was the highest since the 90s.
Yeah, well, it's just the date only goes in my chart only goes back to 1999, so I don't know. So I guess that is technically the 90s. But I just think so whether I think Keith's overall just right. I think just more broadly speaking, I think it's a really fascinating time for a country that's sort of getting squeezed because of debts and lower populations, and whether they raise by 10 basis points or 25 basis points, I'm not sure if it's really going to make that much of a difference. That's kind of a boring answer, but that's my view.
Yeah. So just to set the stage, though, for everyone who's not following this as closely as we are. So we have in the investment world this thing we call the carry trade. So to make it simple, investors all over the world, they are borrowing in Japan, basically paying zero for it. Think of it that way. They would take that amount of money they borrowed. It's in Japanese yen. They would sell the yen and then buy, say, US dollars or euro or Canadian. It doesn't matter. And then they're going to lever that amount up again. So just say you borrow 100 million, all of a sudden you have that levered up to, say, 500. And as long as you're making something greater than 0% on that 500, it can be like something, just a smidgen, but multiply it by 5, it's free money around the world. It's just swishing around out there. The moment you're a bit concerned that rates are going higher in Japan, and all of a sudden your free money is no longer free, and you're saying, I need to start unwinding this a little bit, you start selling everything you held elsewhere. Remember, it's a bigger amount than what you borrowed, and that could create this sort of big capital flow back into Japan. And if it happens very quickly, it's going to create a challenge somewhere in the credit world, because it has to. Someone is not going to get paid on their money. because they won't be able to sell something they have, and then they get pushed offside with their Japanese loan. People have been talking about this for a long time in the investment world. Some people I know they're every morning now they're waking up like Christmas. They can't wait. They think this is it. Hey, it's happening. I'm not convinced that it is happening, but it is something that's it could, but it's attracting a lot of attention, and it's very important for everyone to. So, what causes the 5-year mortgage rate in Canada to go higher, Steve? Who had the Bank of Japan on their bingo card for that one?
He's definitely the prime suspect.
I don't think they did. Yeah.
I guess my point.
You did have that on your card.
I did actually. I guess my point is I just don't think there's the new government there, right wing nationalist government is doing a lot of fiscal stimulus. There's clearly debts and there's delusion about. I mean, they're one of the most indebted countries in the world. And I just don't think 10 or 15 or 25 basis points is going to prevent capital flight. That's what I was trying to say.
And plus, if they crash their bond market, their banks and pension funds, all that crashes as well. So they kind of have an incentive not to crash their bond market. So, Steve, you did ask the question, and you got us going there. So that's where we are.
Well, lots to keep track of. Like I said, the central banks are all on deck as we head into the holiday season here, but we'll cover that more in detail next week. We have the Twinkie bet, of course, which is going to be pretty unexciting. But yeah, lots more to cover. We've got a lot of interviews that will be lining up here over the next several weeks to keep all of you entertained throughout this holiday season. But as always, guys, we appreciate the support, and we'll see you next week.